Most investors are familiar with the S&P 500, a benchmark many aim to beat. But what if I told you there's a way to potentially outperform the S&P 500 while getting paid every single month? Yes, you heard that right. Monthly dividend ETFs can provide you with steady income while offering growth that might even surpass the S&P 500. In today's video, I'll be breaking down the 7 best monthly dividend ETFs that could help you do just that. I'll walk you through each ETF, explaining why they could be strong contenders for your portfolio, and we'll even talk about how you can use these to build a steady income stream. Plus, stick around to the end for some important tax tips to keep more of your money in your pocket. What are dividend ETFs? Before diving into the top ETFs, let's quickly cover what a dividend ETF is. A dividend ETF is an exchange-traded fund that holds a basket of stocks with a strong history of paying dividends. When you invest in a dividend ETF, the fund managers make sure the stocks they select are ones that provide consistent dividend payments to shareholders like you. These funds are a great way to get exposure to dividend-paying companies without having to handpick individual stocks yourself. Instead, you get a diversified group of companies that can provide regular payouts while also offering potential growth over time. Having explained what a dividend ETF is, let's move on to the next part, monthly dividends. You're probably wondering, what exactly are monthly dividend ETFs? Well, just like regular dividend ETFs, these funds invest in companies that pay dividends. The key difference is that they pay you every month instead of quarterly or annually. With monthly dividend ETFs, you receive smaller payments more frequently, every month. This steady stream of income can be especially useful if you're looking for more regular cash flow or if you like to reinvest your dividends to grow your investments faster. According to a study by Hartford Funds, reinvesting dividends accounted for 84% of the S&P 500's total returns between 1960 and 2021. So, if you're serious about building wealth, monthly dividend ETFs could help speed up that process. Now, with that out of the way, let's get into what makes an ETF capable of outperforming the S&P 500. Searching for an ETF that could outperform the S&P 500 involves considering a few important factors. First, check the dividend yield. The dividend yield tells you how much money the ETF pays you back for just owning it. For example, if you invest $100 and get $10 in dividends, the yield is 10%. Next, look at the expense ratio. This is the cost to manage the ETF. The lower the expense ratio, the more money stays in your pocket. A good rule of thumb is to look for an expense ratio lower than the average S&P 500 ETF, which is around 0.03%. After that, look at the performance history. Ask yourself, how has this ETF done in the past few years? If it has consistently beaten the S&P 500, it's worth considering. For instance, if the S&P 500 has returned 10% over 5 years and the ETF returned 12%, that's a great sign. Don't forget about risk. Some ETFs may take on more risk to try for higher returns, and this is known as volatility. If the ETF has lower volatility than the S&P 500, but still performs well, that's a great indicator it could continue to outperform. Finally, consider what sectors the ETF invests in. If it focuses on fast-growing sectors like technology or healthcare, it might have a better shot at beating the S&P 500. Now that you know what to look for, let's get to the 7 top monthly dividend ETFs that could outperform the S&P 500. These ETFs offer steady monthly income and have the potential for capital appreciation over time. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. The Invesco S&P 500 High Dividend Low Volatility ETF is designed to give you exposure to 50 of the least volatile, high-yielding stocks in the S&P 500. This ETF aims to balance high dividend payments with low risk, making it ideal for steady income. It has a SEC 30-day yield of 4.16% and an annual dividend yield of 3.64%, with a low expense ratio of 0.30%. For example, if you invest $10,000 in SPHD, you'll receive around $364 annually in dividends and pay just $30 in fees. Over the years, this fund has demonstrated resilience and growth, making it a great option for income-focused investors. Global X SuperDividend ETF. SDIV. The Global X SuperDividend ETF offers a substantial dividend yield of 10.92%, which is highly attractive to income-focused investors. Its expense ratio is 0.58%, meaning for every $10,000 you invest, you'll pay $58 in fees. SDIV invests in 100 of the highest dividend-paying stocks globally. Over a 10-year period, a $10,000 investment in SDIV could generate significant returns through high dividend yields. With its global exposure, this ETF spreads risk and maximizes income opportunities. WisdomTree U.S. SmallCap Dividend Fund DES. DES has a dividend yield of about 2.84% and an expense ratio of 0.38%. Over the past 5 years, its dividend has grown at an average annual rate of 6.25%. This ETF focuses on small-cap companies with high dividends, offering a chance for both income and growth. If you invested $10,000 today, you'd earn around $625 by the end of the year, and the investment cost would only be $38. DES's unique dividend-weighted strategy gives it a different angle in the market, enhancing income for investors. iShares Preferred and Income Securities ETF, PFF. The iShares Preferred and Income Securities ETF, PFF, is a popular choice for income investors due to its dividend yield of around 5.00% and a low expense ratio of 0.46%. PFF holds over 500 preferred stocks across various sectors, offering broad diversification and steady monthly dividends. It's a great option for those looking for stable income with lower volatility, and it's highly liquid due to its large asset base of over $16 billion. Vanguard International High Dividend Yield ETF, VYMI. VYMI focuses on high dividend-paying companies from international markets. Its dividend yield is 4.49%, and it has a low expense ratio of 0.22%, making it an efficient choice for global investors. With a YTD return of 8.81% as of September 2024, VYMI offers exposure to companies outside the U.S., providing diversification while still delivering strong dividend income. Schwab U.S. Dividend Equity ETF, SCHD. The Schwab U.S. Dividend Equity ETF, SCHD, has a dividend yield of 3.42% and an incredibly low expense ratio of just 0.06%. It focuses on U.S. companies with a strong history of paying consistent dividends. SCHD is diversified across sectors like financials, industrials, and consumer staples, making it a solid, low-cost choice for investors looking for reliable income with lower risk. Global X SuperDividend U.S. FDIV. The Global X SuperDividend U.S. ETF offers a dividend yield of 6.14% with an expense ratio of 0.45%. This ETF focuses on 50 of the highest dividend-paying U.S. companies, including real estate investment trusts, REITs, and master limited partnerships, MLPs. With a year-to-date return of 10.10%, DIV provides a great balance between high yields and strong performance, making it one of the top choices for monthly dividend income. All right, let's dive into the tax implications of monthly dividend ETFs. If you're thinking of investing in these cash cows, remember, taxes are a big deal. You definitely don't want Uncle Sam knocking at your door. Keep your financial ducks in a row and let's make your money work for you without any tax drama. Dividends can be classified as either qualified or non-qualified. Qualified dividends are taxed at lower capital gains rates, while non-qualified dividends are taxed at your regular income tax rate, which can be higher. When you sell shares of an ETF, any profit is subject to capital gains tax. If you've held the shares for more than a year, you'll pay the lower long-term capital gains tax. If you sell within a year, you'll pay the higher short-term capital gains rate. ETFs are generally more tax efficient than mutual funds because of their structure, which helps minimize capital gains distributions. Holding ETFs in tax-advantaged accounts like IRAs or 401ks can help you reduce or eliminate taxes on dividends and gains. If you are interested in finding about more ETFs that can add growth up your portfolio, linked above the screen is a video on the 3 best ETFs to make you wealthy. So now you know the top 7 monthly dividend ETFs that could potentially outperform the S&P 500. From SPHD's low volatility to SDIV's global high yields, these ETFs offer a unique blend of growth and income potential. Investing in dividend ETFs can give you consistent monthly income while also allowing you to participate in market growth. If you found this video helpful, don't forget to give it a thumbs up and hit the subscribe button for more investment tips. Let me know in the comments if there are other topics you'd like me to cover. Catch you in the next video. Your financial future is waiting.